everybody. My name is Marty Chera. My company is Express Capital Financing. We are real estate lenders. We specialize in hard money fix and flips, and also we're a non-bank permanent lender. But like I said before, this is informative information for real estate investors to help them grow their wealth, exactly like John's book has right behind him says, building wealth one house at a time.
Yeah.
So the floor is all yours.
Okay, well, thank you. And if you have any questions, I'm happy to answer questions. But I've been doing this for a long time. I started right out of, actually, before I graduated from college, I was managing an apartment building, a little one, 6 units, but I was, mowing the grass, painting the units, renting them up, doing all the things you do with a small apartment building. And one day a fellow showed up and wanted to buy it. So I had my real estate license because I got that as soon as I could. And I sold it and collected a commission back when I was a young man. From there, I went to the land sales business. I worked in a subdivision, sold a bunch of lots, and we got down to the last 16 lots. And I went to see the owner, and I said, "What are we going to do next?" And he said, "Next." And he said, "You're not family. You just work here." I said, "Oh." So I said, "Sell me the last 16 lots." And he sold me the last 16 lots. I borrowed the money to buy them, and I lived off of those lots for a couple of years till I figured out what I was going to do when I grew up. I bought a real estate brokerage company. I found that I didn't like being a broker. I had a bunch of salesmen for a while, but that didn't make me happy. So I started buying real estate in 1973, and I still own the properties I bought back then. I'm a buy and hold guy. And the reason I'm a buy and hold guy is I studied the people in my town who were very successful with real estate. And there were a lot of developers, there were a lot of guys who were in and out real fast and trying to make a quick buck, But the guys who had the nice houses, who had the nice lifestyles, owned a lot of property, were people that bought quality property and they held on to them. And I was convinced that this is a good town to do that. We're living in a town that's grown from 300,000 to 1.3 million in about 40 years, long time, but it's growing, and it'll continue to grow because it's in a good part of the world. So if you live in a town that's growing, then you have the advantage of increasing prices. If you live in a town that's declining in size, then you use a different strategy to make money. And I'll talk about both sides of this. But I've been not only buying real estate, but I've been studying real estate, and I've been writing about it and teaching about it since the mid 70s. So I've written a number of books, and the book that Martin just mentioned, Building Wealth One House at a Time, has been a bestseller for a number of years. So I highly recommend it to people, especially people getting started. It kind of gives you focus. And I'm going to talk a little bit about why I buy houses now instead of all the other things I've owned. When I started buying, I would buy anything that I could buy with owner financing. To this day, I've never gone to the bank to borrow money to buy a property. For a couple of reasons. First of all, when I first started, they wouldn't lend me any money. And I guess that made me mad, because I couldn't get a loan. I decided I'll figure out how to do it without them. And I did. There turns out there's a lot of people that will sell property and finance it themselves. And the other angle that I used, the other approach I used is I found investors who had money, but didn't want to do the work. They didn't want to buy property. They didn't want to manage property. They just want to be passive investors. So I would work with them, and I would let them be passive, and I would do all the work, and we'd share profits. So I'll talk about that in a second. But the idea of not going to the bank to borrow money to buy real estate, I think a lot of people don't think about. They think that's the way you buy real estate. You go down and you apply for a loan and you wait for the approval and you fill out all the paperwork and sign all the papers. But I can tell you that's not a safe way to do it. If you think about the bank, they're smarter than you are. They have lawyers that you don't have. That paperwork favors them. And if you get in any kind of financial trouble, it's going to cost you a lot of money to defend yourself. You may lose everything. And I've seen people over and over again lose everything because they owed money to banks. If you owe money to an individual, if I buy a house from somebody and for some reason I can't pay them, I go back to them and talk about it. And probably the reason I can't pay them is because something really strange has happened in the economy. We're in a depression or for some reason we can't get the house rented. And they wouldn't want the house back either. So we would be able to renegotiate with them, maybe stretch the payments out, maybe skip a couple payments, do something so we could survive until the market corrected itself. I've been through 7 recessions. And some of them have been humdingers. I mean, there's been some really good ones in my lifetime, and I've survived. I've never gone broke. I've never lost a property. I've renegotiated a few loans, but it's always been to everybody's advantage. And a lot of the properties I've bought from lenders, both private lenders and from banks, who will make me a deal because it was to their advantage to do that. And so you learn that there's different ways to buy property, and there's different kinds of property that you can buy. And I started off buying land, and I bought bigger pieces of land. And then I decided that land didn't pay me very often. The problem with land is you don't get paid until you sell it. And if you study land, and I have, you'll see that prices of land, values of land go way up and way down as we have cycles. We had a piece of land that we bought in 1973, and we had an auction in 1975, and nobody came. So we know the market just disappears sometimes. So we decided that land, although it can be a very good investment, it is for somebody who has very deep pockets and can afford to hold it for years and years and years until it does go up in value. And then if you do the math, I do the math on these things, I say, the value, even if the value doubles every 10 years, I'm still only making 7% of my money, and I'm not getting any income while I wait. So I started buying improved property, and I bought apartments, I bought a motel, I bought commercial properties, I bought duplexes, I bought everything I could buy that had income that I could buy with owner financing. And there was a lot of it. And I was managing all this property myself, and we got big enough where we ended up hiring other people to work for us to manage. And I ended up with property in 10 states at one time, all over the country. And so we had a pretty good size operation, but it was a lot of work. So one day I woke up and decided that we need to figure out how to do this without working as hard. And so we've done two things. Number one, we've moved toward properties that required less management. Management is a function of how often people move in and out of property. And people think commercial properties are the berries, but the problem is commercial tenants don't last very long. Small commercial strip centers, and I had one for a while. We had a lot of turnover. We had a lot of people go out of business, people coming and going all the time. So I was looking for something I could rent to somebody who would stay for a long period of time. My motel people certainly didn't stay very long. My apartment tenants would sometimes stay a year or two, but if we got somebody for 2 years in apartments, we were pretty happy. But I noticed that the houses that I own attracted longer term tenants. So I've started buying houses, and I divested myself of all the high management properties. And today I just own a portfolio of houses which are much lower management. And that's important to me because lifestyle is important to me. I want to do as much as I can to enjoy life, but the only part of that is work. There's a lot more to life than just working. So we ended up with a portfolio, and we're still fine tuning it, but a portfolio of houses in different price ranges, in different neighborhoods, but all in this town. And some people would say that's kind of risky to have everything in one town. But I read Andrew Carnegie's book years and years ago. And his advice was put all your eggs in one basket and watch it like a hawk. And I kind of agree to that. The other advantage of owning one type of property is you develop systems to manage, and you get really good at managing. And if you have a vacancy, if you have a bunch of properties, there's a good chance that one of your tenants would either want that property or would know somebody who wanted that property. So you develop kind of an in-house referral system for both buying property and for renting property. And that's what we've done over the years. So we have started off with very low income houses, and we've moved up the chain over the years. And now we own a variety of houses. We own some houses that are very valuable. And what makes them valuable is that the land that they sit on continues to go up in value. If you study your market, you'll find that some neighborhoods are worth more than others. And typically, if you'll study the land values in those neighborhoods, you'll find that the land is more valuable in those neighborhoods. And when somebody buys a more expensive lot, of course, they build a better house on it. So it all kind of goes hand in hand. But there's a big difference in the ratio between improvements and land values. I mean, if you go to some markets, the expensive markets, you'll find that the land is generally about 6 times as valuable as the improvements. If you go to kind of an average market, you'll find that the land maybe is valuable as 1/3 of the improvements. So the improvements might be twice as valuable as the land. And in some inexpensive markets, you'll find that the improvements might be 4 or 5 times as valuable as the land. Well, if you think that the land is what's going up in value and not the house, and think about that for a second. Is a 50-year-old house as valuable as a brand new house? I mean, is the plumbing as good? Is the materials that it was built with as good? Is the design modern? Is it as desirable to a renter or a new buyer? And the answer may be yes, for some exceptions, but overall, most people prefer a newer, more modern house with modern conveniences, better living spaces, and things like that. So it's not the house really that's going up in value so fast. It's the land underneath that house. So we focused on buying better and better neighborhoods, okay? So the houses that we own are not big fancy houses. A big fancy house is really expensive to maintain. So you don't want a house with 3 air conditioners and 4 bedrooms and 4 baths and all sorts of, 3,000 square feet. That would be a very expensive house to maintain. You want a basic house, a house that you can rent to somebody who will stay for a while. And, I focus on renting to families, although we have a lot of retired people who rent from us. So we rent to people. And one of the questions I ask, which I think is a really important question, is how long would you like to stay in this house? That's a question that I ask prospective tenant. How long would you like to stay in this house? And, if somebody says, well, we just want to stay 6 months, or we're looking to buy a house, or we want to build a house, or we're only here temporarily because our job's just good for a year, I don't rent to them. I'm looking for somebody that has a longer term outlook. I'm looking for somebody that has a reason to stay in that house for years. So the answers I like is, we like this neighborhood because we want our children to go to the school in this neighborhood, and they're in the 3rd grade. We want them to stay in this house for another 9 years. I love that answer. So I'm looking for people that have some reason to stay in that house for a while. And one reason I prefer the houses over the apartments, if you just look at square foot costs and square foot rents, you get higher gross rents in the apartment business, but you also have higher expenses. The national average expenses on a very well managed, professionally managed apartment building is about 50% of the gross income. That goes right out the door for operating expenses, taxes and insurance, and all your maintenance. And the house business is closer to 40% or a little bit lower than 40%, depending on your management and depending on the properties that you buy. Of course, a better built house, a house that's in better condition, a newer house is going to require a lot less maintenance than a really old house. And if somebody buys a 60-year-old house, I mean, they're going to end up spending a lot of money just keeping that house functioning. But if you buy a 5 or 10 or 15 or 20-year-old house, and this guy has a new roof and new furnace or air conditioning and everything seems to work, your maintenance costs will be much lower. And the other thing I found is that's the one that tenants want to rent. They want to rent the newer, better looking house. So over the years, we've bought a lot of new houses. We've built houses. So we've had quite an inventory of either brand new houses or houses that maybe are just a year or 2 old. And those houses have had much lower maintenance costs. So it keeps our maintenance way below the 40%, or our expenses way below 40% expense. So if you're looking for cash flow, you look for 2 things. The primary determinant of cash flow is not how much you pay for the house. It's your financing. Okay? It depends on what kind of payments you have. You can't really adjust the rent. The rent is the market rent. So if the rent's $2,000 a month on the house you're buying, you can't charge $2,500 a month just because your payments are high. You can only charge $2,000. In fact, if you try to charge too much money, you'll sit empty for months. And so your annual income will be a whole bunch lower. So it's just common sense that you want to have your rents, I think, on the low side of market, not the high side of market. There's a lot of conversation about hedge funds and the properties they bought over the last few years, and people seem to be real excited about that. There's a lot of houses in the world, and the hedge funds have bought a couple 100,000 of them, but there's millions and millions and millions of houses. So they've just bought about maybe 1%, even less than that, of the total market. And the hedge fund people get paid 2 ways. They get a percentage of the amount of assets they manage, which is generally pretty low, say 1 or 2%. Then they get a piece of the action. They get a percentage of the profits they make, and that's higher. That's generally 15 or 20%. So if you think about what you would do if you were a hedge fund manager, if you bought a whole bunch of houses here over the last 5 or 10 years, they've all gone up in value, they've all doubled, your big payday is going to come when you sell those houses. So I'm pretty sure they're going to be selling some of those houses here as this market gets hotter and hotter. because they'll look at their profits, they'll look at how they get paid. And even though they're managing more money and getting a small percentage of the amount of money they manage, they would much rather have that 20% piece of the action, I think, when they sell. And 20% of the rents is not a very impressive number, but 20% of the sale price will be a very impressive number. So my prediction is that the hedge funds who bought during the last downturn and made some terrific deals, and then they went into markets and bought some terrific deals, they're slowing down their buying now because prices are higher and they're not getting terrific deals anymore. I've talked to a number of people who have sold things to hedge funds and other institutional buyers at more than retail prices, retail plus 5%. Well, you don't make a lot of money paying retail plus 5%. So I expect that they're going to figure this out over the next few years. And when they do, I expect them not to be in the market. They're really not a problem for me. The hedge funds people in my town, and they bought probably 1,000, maybe several thousand houses here, charge too much rent. They charge high market rent. So they may be charging $2,400 a month for a house I rent for $2,000 a month. Who's going to lose a tenant if we have a little downturn? Who's going to lose a tenant if we have a little unemployment? It'll be the people who are in those high rent houses who will be looking for something cheaper. My people won't be looking for something cheaper. They already have a good deal, so that they're going to stay right where they are. And that's a really important concept. You want to rent to people who have this long-term perspective, who like your houses. You give them a fair rent, you maintain the house, you keep it in good shape, and then you keep them for a long period of time. My average tenant stays about 10 years. And I have people who have been with me, many people have been with me more than 20 years. I have some people who have been with me more than 30 years. Well, if you think about the effect of having a long-term tenant on your cash flow and your long-term profits, it's remarkable. If somebody stays in a house 10 years and you have no vacant days for 10 years, your maintenance costs in that house will be very low because you don't have to paint the inside of it for 10 years. You don't have to do anything to the floor covering for 10 years. They'll live with that house just the way it is for that 10-year period of time. Now, if they move out after 10 years, I have a tenant that's moving out right now after 16 years. Of course, we've gone in and cleaned up the house and repainted the house, and we're fixing up all the things that needed to be maintained. So we'll spend several $1,000s dolling this house back up again before we either rent it or sell it. But we've had 16 years of very low maintenance and no vacancies. That's a big number. If you're in an apartment business and your average vacancy is 1 month a year or 2 weeks a year, that adds up to a lot of vacant days over 10 or 15 years. So think about the plan of buying a property that'll attract a tenant that'll stay a long period of time. That's our plan. I try to do it with as few moving parts as possible. And when I say that, I mean, I don't want to have more properties than I need. I hear people say, we're going to buy 100 houses. And I had that goal at one time, but I always ask them why. What's your purpose in owning 100 houses? If you could make it work with 10 houses or 15 or 20 houses, wouldn't your life be simpler? Wouldn't you have fewer things to manage? And the obvious answer is sure. So our goal is to have as few properties as possible, yet have the income we need and have the best properties that we can afford. So those properties in the better neighborhoods will have more long-term appreciation than the properties in the weaker neighborhoods. Just makes common sense. So think through all this. If you want a lot more detail, read the book, Building Wealth One House at a Time. It's on Amazon. I don't sell them here at the office, but it's on Amazon. And it'll fill in a lot of the blanks for you. It'll give you some real specifics on which house, why that house, and how to manage a little bit. So I'm going to stop and see if you have any questions, Martin. I've been talking here for a while. See if I've inspired any thought at all with you. Any thought?
No, I mean, it's very informative. But if I heard you correctly, you were saying don't worry about the cost of the house, the purchase price. Be concerned with the financing only.
I said the purchase price is not determined, doesn't have a big influence on your cash flow. Big influence on your cash. If you paid $250,000 or $275,000 for a house today, that's a $25,000 spread. But you finance both of them, over a long period of time at a low interest rate. The difference in the payments can be pretty nominal. If you can just get into the market, buy something, buy that $250,000 house, or depending on where you live, $500,000 house, and hold on to it until it doubles in value, that's where your big profit is. Now that's going to take a while. This is not a 6-month plan. This is not get rich in 90 days or anything. This is accumulate wealth and do it systematically. So over the long run, and 10 years is the long run. Over a 10-year period of time, if you start buying houses, and in my book, I talk about buying one house a year, nothing dramatic, nothing real fancy, but one house a year for 10 years, you end up owning 10 houses in 10 years if you stick with that plan. And if they started off, call it $250,000 today, that first house will probably have doubled in a 10-year period of time. So you'll have a $250,000 profit in that first house. And even if you only have a $225,000 profit because you paid $275 instead of $250, it's not going to be a big deal. Okay. The big deal is, can you hold it for 10 years? Can you hold it for 10 years? So the question you should ask yourself when you buy real estate, I think, is, am I willing to hold this property until it doubles in value? And that could take longer than 10 years. It might take 15 years sometimes. Sometimes it happens in 5 or 6 years. Depends on the market. And it depends on where you buy. If you buy right at the top of the market, it's going to take longer to double. If you buy right at the bottom of the market, it'll double pretty fast. So, but you can't really, it's hard to time a market. I can't really predict what's going to happen next year. I can predict, but I can't predict accurately. And, of all of 7 recessions we've had, I didn't see a single one coming. I didn't call any of them. And 2 years ago, we had a big meeting and we didn't, we had some of the smartest guys that I know sitting around a table. None of them saw what happened in the last 2 years. None of them saw this market go like it did. It's really hard to predict what's going to happen in the next 2 years or the next 10 years. But I think you can count on real estate in good areas, in good neighborhoods. You can count on the fact that you can rent that house for the next 10 years. And if you keep your rents a little bit below the market and maintain that property, you could probably attract a really good tenant. And even if you had 2 or 3 tenants over 10 years, because you're not really a pro at this yet, that's still a good game. That doesn't take a lot of your time to manage. So to manage 10 houses, if everybody stays, it takes very little time. If everybody moves out every year, then you've got to go to work every 12 months and rent those houses up. But if you'll focus on renting with people that will stay for a while, it makes that much simpler. So the whole idea then is to think before you buy something, and you want to buy the highest quality property or in the best neighborhoods. Think of it this way. You want to buy in the best neighborhoods that you can make sense out of, in your town, that you can make sense out of. Every one of us are different. We all have different incomes. We have different net worths. We have different money in the bank. So, if you have a really good job and you're making more money than you need to spend, you don't need to buy a house that has a bunch of cash flow because you've already got all the cash flow you need. On the other side, if you don't have any cash flow, now you need to structure a deal that gives you cash flow today. So we can talk about both of those if you want to. But think about the concept is buy something that you are willing to hold until it doubles. That means you're willing to manage it until it doubles. So don't go out and buy a 20-unit apartment building or a motel because it'll just wear you out. 10 houses probably in most markets will have much more value than even a 20-unit apartment building. So 10 houses are far simpler to manage than a 20-unit building and will probably make you a lot more money. And that's why I'm still in the house business today, is I've owned both. I've owned the apartment buildings. I've managed the apartment buildings myself. I manage my houses myself. I do it all myself today. And I can tell you, it doesn't take much time. It doesn't make much time. So that's kind of long and short. Did I answer your question about the price?
You did to me, and I hope everybody else understood it. So, yeah, I always tell my investors, my clients also, sometimes they get emotional. Oh, I got outbidded by $10,000 or $20,000. I said, in the scheme of things, is that so bad? You own the property, you're in control. Rent is going to go up at least 5 or 10% a year. You got forced appreciation, you got forced depreciation. So it's just sometimes they get emotional with that $5,000, $10,000, or $15,000 that they got outbidded. Like, just what are your thoughts? Because I tell my people, you should have still bought it.
Yeah. You need to do this with the kind of a long-term outlook and with the end in sight. And if the end in sight is you want to have $1 million net worth, you've got to ask the question, how do I end up with $1 million net worth? And the only way I know of is appreciation. It's really hard to save $1 million. It's hard to earn it, pay taxes on it, save up $1 million. You could have $1 million in cash flow off of rentals if you buy enough of them. But if you just buy one house a year and you get them paid off, you end up with 10 houses 10 years from now, and maybe 3 or 4 of them are paid for, and you work on paying the rest of them off. At some point, you'll have 10 free and clear houses. I have lots of students that have 10 free and clear houses, and some of them are only worth a couple $100,000. Sometimes they're worth $800,000 a piece. So they have a lot of capital, and they have a lot of cash flow once they pay off that debt. And it doesn't make any difference when they have that $800,000 house, if they bought it for 200 or 300. What made the difference was they held on to it. They bought it and they held on to it. So of course, in my book, I talk about 10, 10, 10. I say you should try to buy 10% below the market, because why not? It just takes some work. It takes more offers. It takes more effort on your part, but you can buy 10% below the market if you'll work at it. You shouldn't put more than 10% down, because if you start buying property, you want to buy with as much leverage as you can. That's how you get wealthy, is buy with leverage. And then I say you shouldn't pay more than 10% interest. If people say, well, 10% is too much, I said, you shouldn't pay more than 10% interest. If you can pay less than 10% interest, that's terrific. If you can get a 3% loan, I've sold a couple of houses this year to people that have been able to finance them at 2.75% for 30 years. Well, if you can get a 2.75% 30-year loan, take it, But I also know people are paying 14% and 2 points right now to buy real estate. I think that's a mistake. Now, if you're a flipper, if you're a speculator, buying and selling things, and you're going to make a quick profit, then you pay the higher interest rate. But you can't do that as an investor that's going to hold a property 10 or 20 years. There's no reason to pay 14%. Look for a deal where you can buy it cheap. I know you're a hard money lender. I'm a hard money lender. I don't like lending money right now because the rates are too low, and the deals are not good enough. The last really good deal I made was 16% loan, 5 years, 16% loan. And the guy bought something for 50 cents on the dollar. And when somebody buys something for 50 cents on the dollar and they made a down payment, then I know I'm very safe on that loan. Why did he pay me 16%? He couldn't get the money anyplace else. Banks wouldn't lend him money. No other investors were lending money. I'd lend him money because I understood the product. I understood what he bought. And it was a great deal for both of us. He made a ton of money on that property. I'm real happy with 16%. But I don't get 16% today very often. I'm not even advertising because people are paying too much for property sometimes. I gotta be careful that you don't finance something where people paid retail plus 10%. You get that property back as a lender, you're upside down.
I hear you. I wish I could charge 60%. That was like 5-6 years ago. Today it's like 8-9% on the hard money side. Okay. I mean, how do you feel? Like, what is your thoughts on I know nobody can predict, but what are your thoughts right now on the real estate market with its current conditions?
Well, the current conditions are hotter than a firecracker here. I'm not, every town's a little different, but we had 27% appreciation last year according to Zillow. If you that make you feel good if you read Zillow, But I know houses went up a lot last year. We have a very short inventory. We've got one island I've got a house on and we'll sell. On the whole island, there's only 2 houses for sale, and there's like 3,000 houses on this island. There's 2 for sale. So, there's hardly any inventory. So you pretty much get to name your price as a seller right now. And if you had something you haven't been able to sell, or you have something that you don't like, it's still a terrific time to sell. So sell. You should always be looking for buys. I can't predict what's going to happen next year. I'm convinced that over the next 10 years, that the dollar will continue to devalue. So we wake up 10 years from now, the dollar is going to buy less, which means hard assets like real estate will go up in value a lot. So I would suggest 2 approaches. Number one, leverage if you can get a great loan. Leverage if you can get a low interest rate, fixed rate loan, long-term, low payments, and you can afford to make those payments. And interestingly enough, rents are high right now too. So the house, I sold a house to a young lady, and she paid me $275,000 for it, I think. And she went out and got about a 3% loan. So her payments are like $1,200 a month. That house today will rent for $2,200 a month. And if she wanted to move out and rent that house, she'd have $1,000 a month cash flow. Now that's gross, but that includes her payments, taxes, and insurance. And the maintenance won't be high because that house is in good shape. So you can buy a house today with a low interest rate, fixed rate loan and rent it for a profit, and pay retail price and rent it for a profit. That's fairly unusual. And that's only because rates are so low. So my guess over the next 10 years is rates will probably go up. If you think about who benefits from inflation, it's people who have debt, right? If you're $1 million in debt, and we have 10% inflation next year, that means about 10% of your debt was erased. Well, who's the biggest debtor in the world? That's the government. So if we can have 10%, they have this target inflation, and now they're admitting, because they've raised everybody's Social Security 5 point some odd percent, 5.7 or whatever it is, that we had at least that much inflation last year. Well, that erases 5% of call it a $30 trillion debt. That's a lot of money to disappear. So by devaluating the dollar, which I think the government will do forever, this is what our country is based on, is trying to give more benefits than they collect in taxes. I don't see them raising taxes at a high enough rate to be able to pay the debt down or pay the debt off. But I see them devaluing that debt by continuing to inflate over the years. So investing in hard assets, and whether or not they go up or down next year, it really doesn't make any difference. If my houses went down 30% next year, I'm not going to sell them. We actually had a 50% drop in value in this town 12 years ago. 50% drop. We had houses. I had a house that was sold for $320. I ended up selling it for $140. That's a heck of a drop in value, right? So that's the real world, and I've lived through that. So I know that could happen again, but that was the only house that I sold during that period of time. And there's more of a story to it than just that, of course. But we held on to all the rest of the houses, even though they went down in value. We weren't under any pressure to sell, because we were able to collect rent and make our payments. So whatever happens next year, if they go up or down next year, is not that important. What's important is that you get in the game, and you get in the game, it's with the best deal that you can, with the lowest interest rate you can, with the lowest down payment, with the best property. And it takes work to do all that. I don't discount it takes a little bit of work to go out and buy something below the market with a low interest rate in a really good neighborhood. But once you make that deal, you've done something very smart, and that house will make you a lot of money. And the rates of return on a deal like that are not 5 or 10 or 15%. They're like 30 or 40%, and they get better over time because the rents compound and the values compound. So the properties we bought years and years ago have doubled 5 or 6 times. I don't mean they went up 5 times. I mean they doubled 5 times. They went from 30 to 60 to 120 to 240 to 480 to 960. They went up that much. And if you hold on to houses, that one house can make you a whole bunch of money.
Yep. How much of that 140 house that you sold 4 years ago is worth today, you think?
300.
Yep.
The reason I sold it is I didn't like it to start with. It wasn't the right house. I got suckered into buying that house, and actually I ended up, it was a loan deal. It was a loan deal that went bad. You've seen that. But one reason I'm not lending money now is I loaned a lot of money to flippers back in 2007, 2008, 2009, and they were making good money, and they were good people, and they didn't do anything wrong. The market turned on them, and they just couldn't sell. So I got a whole bunch of houses back that were partially fixed up in some cases. The guy didn't put the kitchen back in because he ran out of money. And that was a bad time to have a whole bunch of houses back because you couldn't sell them to anybody. So we sold a couple big losers, and then we just paid the price, but not all of them. And the other thing is, if they go up, you don't sell them when they go up. I mean, there's a time to sell. I mean, and it's personal. You sell when you get to a point where you don't want any more real estate. And you have something you want to do with the money, and that's what real estate's for. The money is for spending. The money's for having some fun, buying assets, helping your kids do things, helping your grandkids do things. That's what the money's for. So at some point, you sell and use the money to do all those fun things.
Yep. Just hope this 1031 does not get destroyed. That'll kill us all.
I don't think they're going to wipe out 1031. I don't think they'll wipe out stepped up bases, because the people who have a lot of money, and there are a lot of people who have a lot of money, they rely on those two things to not pay a ton in taxes. And of course, if you eliminate stepped up basis, every small farmer in the world is going to go broke, because when they die, nobody's going to be able to afford to pay the taxes on 300 acres. It just won't make sense. So those things have pretty well been shot down, I think. They will raise the marginal rate. They'll raise the capital gain rate, and but it's just going to go up a little bit. And that's okay. That's okay. I've always said, if you can't outsmart the government, go to work for them. The post office is hiring. You can get a good job, nice stable retirement and all that. But it's more fun to understand how to use a strategy, a totally legal strategy, but a strategy to compound wealth without paying a whole bunch of taxes. And the house is a perfect vehicle. I mean, the house that I bought in 1973 that I still have is worth a whole bunch more. And I haven't paid a dime in taxes on it because I haven't sold it. Still haven't.
Just curiosity, I mean, for the folks out there also, you're saying step-up basis. Would you mind explaining to them what that means on a 1031, the step-up basis?
A stepped up basis is what your children or your heirs get if they inherit property, because the current tax law says there's no gain due at death, okay, except for the state taxes, and the numbers are big now. But so if my child inherits a house, let's say I bought a house years ago for $50,000 and now it's worth $500,000 and I die, and my heir or heirs inherit that $500,000 house that I paid $50,000 for, they would have a new basis as of the date of my death of the fair market value of that house. So if it's worth $500,000, their basis is $500,000, which means they can sell that house the next day and not pay any capital gains tax. They don't have to pay tax.
So that's a good thing for investors.
Say again?
That's a good thing for investors.
No, it's a terrific thing. Well, it's a good thing for our investors' kids. Doesn't affect the investors much.
I want to make sure that the audience understands. Got it.
Yeah.
Okay.
Look, here's a goal. Make sure you inherit something because you'll get to stepped up basis. Encourage your parents to buy a nice house, get them into business. I encourage my parents. I mean, I helped my parents buy property. I helped them buy rental properties and I managed them for them because I know the game. I know when they died, and they've all died, that I get to step up basis and all that property. So that's a big deal.
Got it. Okay. So we have one question here from Marquis Pollard asking, how do you buy a new construction without any bank financing?
Yeah, the question is, how do you buy new construction without bank financing? Well, there's one of two ways. One is the builder gets in trouble and wants to unload the property. And we bought inventories, we bought 12 houses from one builder who owned them in a market that got soft. Builders don't want to rent those properties. They're brand new houses. They don't want to rent them. So his only option is to sell. And if the market is soft and he can't sell them, and you come in and buy one or more than one from a builder, they'll literally give you the property to get them off of the loan. There's generally a construction loan involved. Depends on who the lender is. Sometimes you have enough leverage to go to that lender and say, look, do you want these houses back? And if you don't, I'll manage them. I'll collect a rent. I'll make payments to you, but I can't pay off your loan. And I'm not going to go out and borrow more money because nobody else will lend money on this deal. So you might have some leverage with the builder and with the lender. And we've made a lot of deals just like that. The other way is that if you know that these new houses are bargains, find an investor who has money sitting in the bank earning 6.6%, not making any return at all, and somebody who doesn't like the stock market and would like to invest in real estate but doesn't know how and doesn't have the time, doesn't want to do the work, and say to them, you put up the money to buy this house, I'll manage it, we'll split the profits when we sell it. So you don't have to do any work. It'll be a free and clear house. You put up all the cash. You can. I don't like to do projections with people, but I think it's safe to say, let's hold this house until it doubles in value. And when it doubles in value, then we'll split the profit. We'll sell it and split the profits unless we decide to keep it longer. You can fine tune that a little bit. I had one investor that we bought a lot of new houses together. And what I would do with them is we get the houses under contract. I'd assign my interest in the contract to the investor. The investor would go down to the bank and borrow money. If you have an investor who has credit, who can borrow money, and they could go out and get, let's say, a 5% loan right now, a 5% 30-year investor loan, that's a terrific loan. So you find a new house you want to buy, let's say it's a $400,000 house. You find an investor who's willing to put 20% down, $80,000 down, and can go out and borrow $320,000 at a 5% loan. You would have enough cash flow from the rents to probably cover that loan. You have to do the math. Every house is different, but I'm assuming it's in a market where the typical house is $500,000. if you can, there's markets all over the world that have different numbers. I can take you to towns right now where you can still buy a house for $50,000. And of course, I can take you to a town where the average house is almost $2 million. So there's this big range in there. And people sometimes chase the cheaper towns. They say, let's go to a town where we can still buy a house for $50,000. And I ask them this question. I said, over the last 20 years, how much did that $50,000 house go up? In the next 20 years, how much is that $50,000 house going to go up? Would you really like to own that $50,000 house, or would you rather own a house that's gone from $50,000 maybe 30 years ago to $500,000 today, and probably will go to $1 million in the next 10, 15 years, So you have to think about why you're buying these houses. I buy the houses because I'm confident that over time we'll have increase in value because the dollar will go down in value. Plus, people are moving to my town. So we had this demand supply factor working in our favor, where we have more people that want to buy than we can build houses for right now. At some point, that'll turn around. At some point, there won't be as many buyers as there will be houses for sale. And when that happens, prices will stabilize. They'll go down probably in some areas.
Okay.
So that's two different ways to do it.
Yep. Okay. I don't see any more questions. Anybody have any more questions for John Schaub? Nope. Okay. So, John, I want to thank you so much for the information. I'm sure I find everybody else finds it very informative. You could always buy his book, Building Wealth One House at a Time. And my name is Marty Chera from Express Capital Financing. We are real estate lenders. I put my information on the on the chat. John, you want to give anybody your information out there if they want to reach out to you for anything?
Sure. The best way to reach me is through my website, which is johnschaub.com. So just my name, JOHNSCHAUB.com. And you can go on there. There's a contact blank. You can fill out information and I can get a hold of you, or you can see other things we've done. I don't teach much. I teach generally one class a year. So it's a very, very rare thing. But when I teach a class, we generally do it here in Sarasota. And we limit the size of the class to about 70 people. And then we actually go out in the field and buy properties. So it's a hands-on seminar. And I show people how to recognize opportunities, how to make the offers. And we always find deals doing that. And we'd find deals in every market. One thing your listeners need to know, that there's always a deal out there. It's just a matter of finding it. It's just a matter of talking to enough people until if we find somebody who wants to sell a house, they want to sell it now. They want to sell it today. Once you do that, you'll make a deal.
And when there's uncertainty, there's going to be great opportunity. And unfortunately, this pandemic created a lot of uncertainty out there. Would you agree?
I do agree. And there's always uncertainty in the market. And think about it this way: there's always people that are uncertain. It doesn't mean everybody's uncertain. There's always people. And when I have a group of people together, I'll ask for a show of hands. I said, how many people think the market's going to go up next year? About half of them will raise their hands. I said, how many think it's going to go down? The other half will raise their hands. No, not everybody has the same outlook on what's going to happen. Some of them are nervous about what's going to happen next year. They want to sell this year. Other people think it's going to go up next year. They want to buy this year. That's what makes the world go around. There's buyers and sellers every market.
Great information. Great information. I mean, look, my input is, unfortunately, this pandemic has created a lot of uncertainty from, people moving out of the state, out of the country, living with their children or the family in a different state, divorce liens, tax liens, probates, pre-foreclosures. So it's just a forced uncertainty. That's just my perspective of this situation that caused it. But Jonathan, very informative. I put your information on the chat as well, too. If nobody has any more questions, I guess we will end this webinar. No more questions, anybody? All right, thank you, everybody, for joining. And John, thank you so much, and God bless.
Thank you, Martin. Appreciate it.
Thank you. Bye-bye.